Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Flat for the markets, we've been talking about individual stocks, and we went into break talking about how exactly the entire metal space is doing, and we have on the losing side something like Hero MotoCorp. So I think it's testing its 100-day moving average. But besides that, Sun Pharma, which had a very good trading session yesterday, is seeing some amount of profit booking today. So there's no real follow-on buying which is coming in for Sun Pharma. That stock down around 1%. But as we head into 2018, CNBC TV18's Marketwallahs, Mr. SP Tulsian, Prakash Diwan, Ambareesh Baliga and Mehraboon Irani gave us their top bets for the new year. Here are some of their top bets from last evening.
Very low equity at about maybe 70 crore with a face value of 10 rupees, and market capitalization and or the EV is quite low, seen at about 7,600 crore as market cap and EV at 9,100 crore. And that translates into cement per ton capacity at about $110. But the best part is that company has already taken up the capacity expansion to 14 million ton, and that should get completed in maybe next 12 months or so. So maybe for FY19, I won't be surprised to see the EPS moving to about 78 to 82 rupees, which is likely to be at about 58 to 60 for FY18. So taking all this into consideration, share is likely to give a level of about 1370 in 2018, which is now ruling at sub 1100 rupees.
My sense is Jet has started doing a lot of things in terms of cutting down costs. The efficiencies would change dramatically. And if you have a KLM or an Air France or somebody bailing them out on the balance sheet, so apart from P&L, the balance sheet will also start getting repaired quite well. And if you notice, quietly there's been a reconstitution of the board itself. So from a lot of people who are just iconic names and generalists sitting on the board, they've actually got people with experience from aviation and similar sectors. And that's driving things very rapidly. So if Jet transforms itself, it'll get rewarded very easily. I wouldn't be surprised if it goes to that 1100 kind of a mark as well. So I know it's already moved quite well, but it will be volatile. It's not going to be a smooth ride, but it will reward if people patiently hold on to it, especially this year.
Mr. Sheshadri has joined in, who has years of experience with Citi, and he's expected to change the face of the bank. And now with the clear focus, again, back on SME and retail, I actually expect this bank to start doing well, possibly after a gap of either 3 or 4 quarters. There has been infusion of funds through rights. So I expect the bank to maintain those NIMs currently, and expect that to move up in FY19 and 20, because of which you'll have the EPS moving up. So I think the downside at these levels is very minimal. I think that's what one should look at whenever you're buying stocks at Sensex 34,000. So upside I'm looking at is about 160 in the next 9 to 12 months.
Edelweiss is not the small player in the capital market segment which it was years ago. It has evolved itself. It's gone into lending business, started with wholesale lending, now into retail lending, where it is meeting with a lot of traction. Earnings could show an exponential growth over the next 2-3 years. It's difficult to quantify it. Current year should be a 10 rupees EPS, which should possibly become maybe even a 20 rupees in the next 2 years. I don't rule it out. So at 290 rupees, 100 becomes 290. Should I buy into it? The answer is, if it's going to become 450, why should I possibly bother of a 230, 240, 250 coming again? I would put it that way. It's very difficult to time stocks like Edelweiss, which is showing exponential growth. So I will stick to it and recommend it as one of the best picks of mine for 2018 also.
Okay, a lot of multi-baggers there, and you can hear those multi-baggers through the course of the day. For now, let's get back to the technicals. Still flat for the market, but there are some stocks that are coming under a bit of pressure. Ashwini Gujral of ashwinigujral.com joins in. Ashwini, first a word on the Nifty. We have so far at least managed to negotiate that low of yesterday, the 10,469 level, just about okay. What's the trade for the rest of the day?
You know, I don't understand this word negotiation because you're hanging around the lows of the day. So basically, after yesterday's trend move, it's kind of, holding around the lows. It will take, one swoosh like yesterday and things will start to collapse. There is no evidence, great buying has come back in financials, etc. So people should be very cautious if they are long, because we have clearly rejected 10,000 530, 550 zone. And, from here, I think once yesterday's low goes, a lot of people will cut long positions and take further shorts. So my sense is that we are just waiting for the midday to cross. And again, I would like to reiterate the point that if today we again start trending down, the twin expiries will, exaggerate the move. So that people should be careful of. Don't keep assuming that, it'll be a choppy day. Having said that, calls right now, RIL is a sell with a stop of 925, target of 900. Balrampur Chini is a sell with a stop of 136, target of 124. And UPL is a buy with a stop of 748, target of 770.
Okay. What kind of answer are you giving your clients who are asking you about Relcom, Ashwini, including today's move?
These are stocks for people who don't know what they are doing. If you can operate in normal stocks, I don't think you need to bet on RCom. In any case, I think the F&O bans have applied, so you can't do it in futures. Nobody can say if you have something going up 100%, where is the stop? How do you enter? The problem with this is that everybody gets onto the bandwagon, starts expecting 50, 60, and again what happens is what happened with JP Associates. So my sense is if you've made money, you are lucky, take it off.
Okay, that's some sane advice coming in. You can burn your fingers quite a bit in stocks like this. So let's talk about some Twitter queries that are coming in. This time the query is from Ronak. He has 230 shares of Bajaj Finance. He bought it at 1100 rupees and he wants to know if he should hold or sell. Let me just get the Bajaj Finance stock up. It's at about 1760. So that's what, about a 60% rise from where he bought it at. Ashwini, time to book his profits or time to hold?
Well, it's not relevant where he bought. He should just see the size of the rally. If something is moved up, 20 times, now the situation is becoming ripe for NBFCs to have probably spend 1 year just consolidating. So if you can't hold through a consolidation, you should book out. Now is the time to shift into oil or metals, etc. Global plays, pharma, IT. So the NBFC move may not happen like it did, in the early part of the year. So that way you have to take a call, but longer term, we are capital starved, and anybody who's lending capital to people who return it is going to do well.
Okay, well, the other one is from is a Twitter user who has Glenmark, which is bought at 700 and wants to know the view on this stock.
See, now on pharma, there could be one news and could move up 20-25%. That's a separate issue. But there are many stocks which are trading above their 200-day moving averages. Those are better stocks technically where bigger buying is coming back. So if I were him, I would probably look at a DVs instead of a Glenmark. Glenmark is one of the underperformers.
Oh yes, Glenmark has been a very frustrating, absolutely flat for the markets, but there's plenty happening in the economy and plenty happening in individual stocks. So let's get talking to Gaurav Mehta, the fund manager at Ambit Asset Management, who joins in now to discuss the fundamentals of the market. Gaurav, hi, good morning, and thanks so much for joining us. There's a lot of talk that there could be a populist budget this time around. There could be more focus on farmer distress, more schemes could be doled out, etc. Do you think all of that could hamper the upmove of the market, or is this a market that will continue to climb all the walls of worry?
I mean, so clearly, very soon markets will shift their focus on the upcoming budget. But I think one thing to remember is that irrespective of what happens in the budget, eventually what will drive markets higher or lower or keep them range bound is what happens with respect to corporate earnings. And I think there is sufficient reason to believe that on corporate earnings, the worst is behind us. Most of the disruption related to demon and GST is behind. If anything, the recent announcement by the government to prepone the implementation of e-way bill from 1st of April to 1st of February 2018. I think that's a very strong commitment to suggest that implementation of GST will be prime focus. Obviously, falling tax collections has been one reason why that's been preponed, but what it means for listed companies is that the shift from unorganized to organized will happen in a big way, and that in turn should help corporate earnings. Obviously, global economy recovering is a positive tailwind as well. So clearly, on earnings, we should do better from here on. The markets obviously have run up, factoring a bit of that in. So I won't rule out a bit of a consolidation in the markets for the next 3-6 months. Budget and other events will provide some volatility around that. But I think the primary focus for the markets would be for seeing concrete signs of an earnings revival. And if that happens, that will make these valuations look a little more reasonable. And that's when you will perhaps, through this process of consolidation, prepare grounds for any further up move 3-6 months out from where we are right now.
Gaurav, hi, morning. Do you think that the kind of macro concerns that we're seeing on the fringe, such as crude prices as well as the additional borrowing, might weigh on sentiment for the markets in 2018?
Yeah, so clearly the borrowing number that came out was a negative was a surprise. I won't say, I would sort of reserve my judgment on whether it was negative or positive. It was clearly a surprise. There were apprehensions that perhaps it could be on the higher side, but the actual number has been even beyond those expectations. So clearly, that's being reflected in the bond markets today, and that will perhaps have a bit of rub-off on the currency markets as well. On equity markets, I think more than the slippage on the fiscal front itself, I think what will be more important for the markets is to see what is the nature of that extra spending, and if that spending is not predominantly dole-outs and populism driven, but is more to do with productive capacity creation is more towards productive uses in the economy, and I think that slippage in itself should not be that big a worry for markets over the long term. So I think more than the quantum itself is the nature of spending that money is put to use at is what the equity markets will be especially focused on.
Okay. The other big event that we are going to witness today is the SEBI board meet, and the SEBI is now planning to go hammer and tongs in terms of tackling this whole debt pile-up issue. From a market standpoint, if we do see tighter NPA disclosure norms, etc., how would you react?
See, the good part about all of this is that all of these are more incremental in nature. It's not something that is coming up as a shocker or as a specific event. This has been a continuous process that's been on for the last several quarters at least now. So in that sense, I don't think that this is something that is going to be a needle mover either ways in terms of a big reaction from the market. But I think the expectation should be that these norms will become tighter, and as a result, going forward, there will be more transparency in the system. And from a longer-term point of view, therefore, it should be a positive. And any knee jerks around it, I don't think should be anything to worry about for longer-term investors.
Okay, so in the context of your last two answers, then Gaurav, what's your approach towards banks, both PSU as well as private?
So this recapitalization in whichever shape and form it happens, I think is a big positive for PSU banks. But to the extent that they've already run up factoring a lot of that in, and to the extent that you still do not have clear signs of a turnaround with respect to the NPA cycle, we'll still stay clear from public sector banks. On private sector banks, again, the better managed ones are already trading at significantly higher valuations. But overall, our approach would be to look not just for the next 6-12 months, but to be investors for the next 3-5 years. And from that point of view, we'll still continue to focus on better managed private sector banks. Within the broader financial space, that's the only pocket that offers any degree of comfort for long-term investors. That apart, in NBFCs, there are select NBFCs, especially the ones focused on vehicle finance, which we think that are sort of coming out of a phase of consolidation, and with the end industry, which is vehicle financing itself, picking up, especially the ones that are focused on commercial vehicles and and so on. I think that's one piece. The financiers to commercial vehicles is a segment that we like. And that's something that should, both from a structural as well as from a cyclical point of view, give you favorable risk return at this point in time.
Okay, Gaurav, a quick last question before we let you go. It seems as though metals is really the flavor for today, not to mention that these stocks have rallied anywhere between 50 to even 70+% this year. With all these metals in general being at multi-year highs, would you think that there's further upside in 2018 for individual stocks and your approach towards them?
Right. So, our key focus has been not to call every sort of near-term move in the market, but to be with good balance sheets. And as a result of that, perhaps metals is not a sector that gives us a lot of comfort. But I think one underlying factor behind that up move in metals is the fact that there is a strong global recovery underway. And there is no denying the fact that both Europe as well as US are sort of marching along well on the path of economic recovery. And as a result, many of these outward focused sectors that are dependent on the global economy should do well. Metals obviously is a basket that's part of that, but there are several other sectors. For example, light industrial exports. That is a pocket that again should benefit from a global recovery. Even pockets of pharma and IT. Obviously valuations are at very attractive levels today. Plus, as a global recovery materializes, some of these stocks should come back into flavor. So again, that's a pocket, especially mid-cap IT, mid-cap pharma. I think that's a pocket that investors should keep on their radar. And again, the best part about those sectors is that balance sheet health is still strong, and a slightest of uptick on end demand will mean that valuations have significant room to expand. Notwithstanding the fact that earnings recovery should also be strong as a consequence of global recovery. So I think those are the pockets that we'll focus on. Other export-oriented pockets that should do well in our view is specialty chemicals. So to answer your question, we are not necessarily focusing on metal names at the moment, but there are several export-based opportunities that we do like, and where valuations are also, thankfully, because of the short-term events of the last few quarters, where valuations also are significantly in favor.
Okay, well, you have a very happy new year. Thank you so much for joining us and speaking to us on CNBC TV18. Let's take a short break on that note.
Thank you. Happy New Year.
Okay, thanks a lot.
On to our special segment 2018, Look Ahead, and today in focus has to be the macros, the additional borrowing by the government and its impact on the overall macros going into 2018. We have with us Tushar Arora, Senior Economist at HDFC Bank, and Indranil Pan, Chief Economist at IDFC Bank. Afternoon, gentlemen. Mr. Pan, I'm going to start with you. What's your sense in terms of the additional 50,000 crores that the government is going to borrow? And do you expect a breach on the fiscal deficit for FY18 as well as for FY19?
In terms of the borrowing program, I think it's now transparent and absolutely clear that the fiscal deficit target of the 3.2% is not being met. But having said that, the fears in the market was that to contain for the fiscal numbers, there could be a cut in the capital expenditure, and which could have been negative for the growth. Thankfully, that is not happening, and the government has decided to take forward or carry forward with the current speed of capital expenditure, which is the good thing for the economy. For the next year, so given the 50,000 crores and also the 23,000 crores of additional borrowing under the T-bills, the probability of a 3.6% fiscal deficit GDP is now there for the current financial year, which necessarily means that the government would probably want to show a 3.3% target for the next year. In terms of the consolidation path that has anyways been laid down by the FRBM.
Okay, Indranil, morning. We were actually speaking to your namesake, Indranil Sengupta, earlier on the show, and he believes that the fiscal deficit target of this year and next can be met. So that's two different views coming in. Well, let me get Tushar Arora as well, Senior Economist of HDFC Bank, who joins in. Tushar, with weaker GST revenues, weaker tax buoyancy, lower RBI dividend transfer, etc., you think it's going to be a tall ask to meet this fiscal deficit target?
See, there are various arithmetic tools possible to meet the target. So I don't think it's now about whether the government meets the target or not. I think the important question is whether they will cut back the spending in a year when the economy is recovering from the lows of demonetization and from the lows of GST. I think government is sending out a message that they will try to continue on whatever spending they are doing, and they would like to maybe go ahead with a minor breach. We expecting this breach to be around 0.3% of the GDP. So instead of meeting 3.2, they would be ending the year at 3.5% of the GDP. And I think it in a year when we have general elections after some time, in a year when private investment cycle is not doing very well, I think it makes sense for the government to continue supporting the economy, and that's the only good part about it. I think from the market's perspective, bond traders were expecting a minor breach. Bond traders were expecting additional borrowing to come into the tune of around 40 to 50,000 crores. So I think from that angle it is a bit negative, but as far as the growth is concerned, I think that support from the government will stay, and I think that's a good part.
Okay, well, Tushar, I just want to take that point forward, because our earlier guest, who was looking at it from a market point of view, mentioned that the fiscal deficit being breached would be forgivable, but how that 50,000 crores is spent would be more important. So do you think that that 50,000 crores would be just an impetus towards growth, or would it be more used to cover up the lack of the GST collections that we've seen?
It is actually the later. It is not for additional spending in the economy. It is not for any stimulus measure. It is just to cover up the lack of revenues which is not come by this year. GST collection is one thing. Then there was lower than expected dividend from the RBI. So these are things which government is trying to fill the gap. It is not for additional spending, but just to fill the gap from the revenue side.
Okay, that point is taken. Indranil, the higher borrowing by the government has actually realized the worst fears of bond traders. We've seen the way the bond yield, it has been inching up higher. Maybe today there's not been too much of an impact, but in general, your own view on the escalating bond yields and what one can expect in the first half of 2018?
As I was leaving my desk, I think the 10-year was at close to 734, which necessarily means that there has been a 12 to 13 basis points impact from yesterday. Having said that, I think we were anyways looking for a steeper yield curve, given the fact that global yields are also firming up, and expectations from the RBI in terms of further softening of the monetary policy is actually a thing of the past. The other issue that also really needs to be sort of understood is that a significant part of the drop in the yields as well as the general interest rates in the economy was mostly liquidity driven through the demonetization effect. That also has faded out in the most significant way, and we are now sort of into a negative liquidity territory at this point in time. Now, I realize that the government spending at the end of the month can bring some liquidity back to the system, but the critical sort of element of liquidity infusion in the system, apart from demonetization, which was basically the FX resources, that also is possibly not likely in a very significant way, given that we are looking at higher oil prices in the next year, which is likely to worsen the current account deficit. And even as capital flows might continue in the same pace as in the current year, the room for maneuverability on the balance of payments appears to be quite reduced.
Okay, Mr. Pan, the one concern which now rises is that we had that outside chance that maybe the S&P ratings agency could probably change their view a little more favorably, though they have decided what their view on India is currently. Do you think that that is probably going to be pushed further back simply because of this likely breach of fiscal deficit? And do you think that Moody's could also probably rethink their stance now?
I can't really, or I should not really comment on Moody's at this point in time, given the fact they've already upgraded the ratings for India. But coming from a more sort of generalized statement on the atmosphere of the macroeconomics, some of the positivities that were handed over on a platter, given that oil prices had come down significantly, which enabled the government to compress on the subsidy bill, as also raise revenues out of it. And further, given that demonetization had led to a significant drop in the vegetable prices, etc. Some of this is already reversing, and that is the fear that one would sort of have for the macroeconomics at this point in time. But having said that, I'm really not talking about a crisis scenario like in June 2013. It is a relative worsening of the sort of positivities that we were seeing on the macro side. And that is something that the rating agencies and the overall sort of agencies, wherever we are, would really be keeping in mind. The other thing that really sort of is important at this point in time, and which may be relevant for capital flows, one, the global liquidity is likely to shrink. Secondly, some of the Asian countries who are net exporters of commodities and also oil is likely to see better revenue generations and better growth models in 2018 compared to India, which necessarily means that there could be some amount of reallocation of capital flows away from India to the rest of Asia. So that's a risk that really needs to be kept in mind as we step into 2018.
Okay, gentlemen, we've run out of time. Thanks so much for joining us and discussing all the issues with respect to the macros. It's been quite a sleepy morning of trade, you'd have to say. So absolutely flat for the headline indices. The good part is that we haven't breached the lows of yesterday. And the bad part is that the bank nifty has been succumbing to a bit of pressure. So we've had pressure from names like Axis Bank, SBI, Kotak Mahindra Bank and Yes Bank. However, the market absolutely flat for now. So we will wind up with trading hour on that note. Thanks so much for tuning in.